Today, Shanks Group plc report their interim results for the period ending September 30th, 2015. I'm here with Group Chief Executive Peter Dilnot. Peter, so how would you sum up these results?
We've delivered revenue and profit growth in constant currency in the first half, despite some end markets that have been quite challenging. Our cash management has also been strong, delivering net debt lower than expectations. Within the divisions, commercial is particularly encouraging, with our Dutch division generating profits 78% higher than last year. The hazardous waste division has been somewhat impacted by pressures in the oil and gas segment, but has still delivered 4% revenue growth and broadly flat profits. Municipal, very much in line with expectations, profits actually down around 7% due to previously forecast contract changes. So overall, in summary, I think this is a solid set of results, very much in line with the execution of our strategy.
Good news there from the Netherlands, but does this mean the recovery is sustainable?
Yes, I do believe it's sustainable, and that furthermore we can build on it going forwards. Now, it's driven by two factors. Firstly, market recovery, and secondly, our self-help initiatives, and those two things are clearly linked. On the market side, we've seen a long-awaited uptick in construction activities, leading to an 8% increase in our own volumes in that segment. And we've also seen an increase in the demand for our recycling services, partly driven by the incinerator tax and associated regulation. But I believe it's not just the market recovery that's driving the impact on our profits, it really is our self-help initiatives. We have got a clear set of initiatives through our value chain to drive margin expansion. It starts with commercial effectiveness at the front end of our business, securing the right mix and volume and price for our inbound materials. It then moves through into processing, where we're driving continuous improvement, which is increasing the productivity and the throughput of our operational plants. And then at the back end, making sure we get good value for our products. We've got clear initiatives that are focused on this division at the moment and are reading through into improved profits. And I think the important piece is here that we're well positioned to benefit from further market recovery going forwards.
You've mentioned headwinds in oil and gas. What does this actually mean for Shanks?
Well, our hazardous waste division serves the oil and gas segment amongst a number of others, and so clearly any sustained lower oil prices we've seen will have some read through to our business. What we've observed in the first half is a lower demand for our industrial cleaning services as oil companies try to save operational costs, but we expect that to unwind over time and potentially as early as the second half. The other piece is that actually oil volumes and refining is broadly flat in the areas that we serve, and so that part of our business, which is linked to shipping and associated activities, is relatively unaffected. Now, it's important to put that together and say that our hazardous waste division, against that backdrop, has delivered revenue growth, 4% at constant currency, and broadly flat profit. So the outlook for this division remains positive, and we believe we can drive good double-digit earnings growth from here.
Is the investment programme on track?
We have a clear stated strategy to invest in infrastructure where we're advantaged and we can generate attractive returns. The programme is very much on track, with returns actually in the first half at 17.9%, which is well within our target range. I think as importantly, some great progress in the first half. We have successfully commissioned on time our new Barnsley, Doncaster and Rotherham PFI asset, a total of £80 million worth of investment there. And in addition to that, opened and fully commissioned our new Rotterdam Total Care Centre and capacity expansions at ATM in the Netherlands. So the programme is very much on track, and our focus now is to make sure we deliver good earnings growth from the assets that have come online and of course complete the build-out programmes appropriately.
What are your priorities? Are you focusing on organic growth or M&A?
Look, our primary focus has to be on the delivery of our core strategies to deliver organic growth in profit and revenue terms in our divisions. And our real focus now is execution and operational grip to deliver that improvement. And in my mind, that is the currency and the foundation for anything else that the Shanks Group will do. In parallel with that, however, we of course are looking at opportunities to make acquisitions, and some opportunities may arise through market consolidation. But any moves we do make will be very carefully considered and with appropriate capital discipline to make sure that what results is an advantaged business overall and attractive returns for our shareholders.
In summary, what is the outlook for both short and long term?
Well, in the short term, our guidance for the full financial year is very much in line, and we will deliver profit and revenue growth at constant currency. Longer term, the growth drivers on this business remain attractive, and we've got a clear strategy around our three priorities of driving margin expansion, investing in infrastructure, and actively managing our portfolio. And that, coupled with those underlying market growth drivers, will read through into positive earnings and improve returns going forwards. And that's our focus now.
Peter Dilnot, thank you very much.
Thank you.